move right along. So let me share my screen. There we go. And share. And then go ahead and draw a hill. Go to quiz access for the week. Receivables. Quiz access. All right, review. You said number 3, right?
Yes, please.
Okay, well, we see the answer there, but in classic style, I will see if I can do it without the answer.
Yeah, the numbers are different from what I have.
Yeah, that's fine.
I need to know how to calculate it.
Yep. Let's see what we got here. Okay. Grand Company had credit sales of $2,800 in the current period. So credit sales, we have $28,000. Accounts receivable had a beginning balance, AR beginning balance of $6,000 and an ending balance of $7,400. Compute its cash collections from its credit sales for the current period. Okay. So let's think about it this way. Beginning balance plus credit sales. Oops. Let's see. Didn't like that. Plus credit sales minus cash collections equals ending balance, right? Oops.
Okay.
Okay, so this is basically your formula, right? So I got this 6,000 right here. That's the beginning. I know that. I know the ending is 74. And I know the credit sales is 28. There we go. Okay, so now we have pieces of the puzzle. So the question is, how do we get to this number, right? So I could do it a couple different ways. Why don't we just go ahead and let's call this A, this B, this C, this D, right? So if I have A plus B minus C equals D, and I need to solve for C, then I would do, I could swap C and D around, right? So I can do A plus B, oops, plus B minus D equals C, right?
Yep.
So I just do that, then let's just do it by pure math. That plus that minus this should be, what's this number? 26,600. Oh, okay, so that's what it should be. But let's verify that. So 6,000, 2,800 minus 26,600. And then let's just do the sum of these two numbers and voila. So it works out perfectly right. So this is how I would have approached it, yeah?
Okay.
So they're usually starting from, this is exercise 7.3. Okay, so they're testing your knowledge of how you go from a beginning balance to an ending balance within a particular account. All right, and usually that's going to start with a beginning number plus and minus some other numbers, and which are usually debits and credits. and then what your ending number is. And what, depending on the variables they give you, you're gonna have to figure out the unknown.
Mm-hmm.
Okay. So that's why I would have done it this way, so that I figure out, okay, what's the unknown, and then just solve for it and then verify it.
Yeah.
Okay.
Okay.
Did you have another one that you had a problem with?
Yes. 6 on 7-6. Let's see what was the problem on that one.
Number 6. Okay, reporting, recording and reporting allowance for doubtful accounts. Now before, on the other one, it was on like a percentage. The ones I did, I think, were percent of sales, or no, percent of receivables method. I think this one is probably going to ask you for a slightly different method. Okay, so in the first year of operations, CloudBox has credit sales. I just put this all down, even though I may not need it. Credit sales of 212. Its year-end balance in accounts receivable ending is 11,200. And the company estimates that 2,100 of its AR is uncollectible. Okay, so we'll just drop these numbers in. Okay. So credit sales, end of year balance, and it estimates of that balance, 2,100 of it is uncollectible. Okay. Prepare the year-end adjusting entry to estimate the bad debt expense. Okay, well, all things being equal, they don't tell me that there's a current balance in uncollectible, so I have to assume that the balance in uncollectible is 0. Right?
Okay.
That's what I have to assume. So, you know, you usually have a date, you have an account, you have a debit, and you have a credit. So then I would assume that the bad debt expense is going to be the 2,100, and that's going to go to allowance for doubtful accounts. That's going to be 2,100.
Mm-hmm.
That's what I would assume without any other information. Okay, and this will
Okay.
be at the year end, so you'll be like 12/31. Prepare the year end adjusting entry to estimate bad debt expense. Okay, this is what I would do. We'll see if that's right. And then it says, well, let's call this reference actually A. And then it says for B, prepare the current asset section of CloudBox's classified balance sheet, assuming inventory is 25, cash is 17, prepaid is 3. Okay, well, we won't do this.
So on that one, I think, well, I did all those are assets and I added them, but it says it's incomplete. So I'm not sure what I'm missing in there. Should I add
Uh,
the uncollectible part, or I don't know.
yeah, you do. And so you have prepaid, rent.
Mm-hmm.
I may or may not be putting these in order. I have to see what it shows me. Usually you go with usually you'd go with the most liquid first, so cash would be first.
Mm-hmm.
Prepaid rent usually isn't that liquid because you have to wait for something to happen before you get it back. So that was, I think I had it actually right. Inventory is probably right, because that just goes along with sales. AR, actually, AR may go before that. So let's do AR And really, it ends up looking more like this, usually. Let's move this down, something like that. So AR is going to be 11,200, and your uncollectible, your allowance is going to be a minus, what do we calculate, 2,100, for a net AR of equals that plus that. So your total current assets should be the sum of these. Okay, that's how I would do it first, as I'd be not knowing anything else. Okay, the company reports net receivable on the balance sheet. So it's probably just going to be these values right here. You're going to ignore this other calculation when you put it in there,
Okay.
because it's just saying it reports it as a net value, not as the individual values.
Oh, okay.
Okay, so now when I go to this, okay, so that one's fine, right? Bad debt allowance for 2,100. They gave you that. And then on B, cash, net receivables, 25 for inventory and prepaid. Did I get that wrong? I probably got the wrong number, didn't I? Oh, yeah, 3,300. So 5,440, and that's how you fill out that last part.
Okay. So I just need to calculate the net. Yeah, I was confused on
Yep, just the net amount.
the net account receivable. Okay.
Let's see, exercise 7.6. Okay. Did you have a question on any other ones?
Yes. 7. I am
7.
lost on that one.
Okay, number 7. And I think somebody else asked me about 7 as well, so hold on just a second. Let me see what I got here. Number 12 and number 13. Wow, looks like lots of questions. Okay, so number 7. Okay, so 7 is going to be exercise. Exercise 7. Okay. Here we go. Helix reported the following information in his financial statements. Write-offs of accounts receivable were $290 in the current year. Helix did not recover any write-offs. Okay. Determine bad debt expense for the current year. Gotta love these ones. Make your head.
Explain.
There we go. Makes your head kind of explode. Makes mine too. Okay. So I just copied the values over. Makes it a little easier to work with. Straight up. Okay. Helix did not recover any write-offs for the current year. Determine bad debt expense for the current year. Okay, so we can ignore the prior year data, right?
Okay.
This one is just there for I don't know what purpose yet. Let me just scroll down. Just didn't want to do that. Okay. So all we're doing is focusing on here. What is the bad debt expense for the current year? Okay, so allowance. This is a direct write-off method, yeah? Okay. So this is okay. This is a little tricky in the sense that you have to understand what's going on, which it's kind of hard to figure out even for me sometimes. So we know that they wrote off $290 in accounts receivable. So we know on one sense, okay, let's see a reference. This is this A. Let's input this right here. Insert. We have our account, and we have our debit, and we have our credit. Okay, so they would have already done a bad debt expense of 290, and that would have gone to that would have come from accounts receivable. So well, actually their allowance. That's a 290. Okay, but the difference between the 580 and the 290 is what they're driving for. Because we already did 290 of it. They wrote it off though, but they didn't. I'm trying to think through this a little bit because this does not make a lot of sense to me. I'm trying to make sense of it, so forgive me. I don't bad debt and allowance. So if we take the difference between the 580 minus the 290, that gives us another 290. That's not the answer though, is it? Oh. Allowance for doubtful accounts is 580. In the current year, what was the bad debt expense? 290 is what was written off. So normally we would just write that off directly from accounts receivable and go to bad debt. And then we had to figure out the allowance. Yeah, this doesn't make sense to me. There's an explanation here. Let's see what it does. Probably about, so they are taking the prior year information. That's the beginning balance. Minus the write-off gives you this balance. Okay. So you can't ignore this number. You have to do very similar to what we did before, which is the beginning balance for allowance, right? Plus additions. Plus additions minus subtractions. So this would be whatever. This would be whatever additions would be credits. So whatever you added to it, and this would be debits, whatever you removed from it. Or let's say these are write-offs. And this is additions or accruals. Equals your ending balance. Okay. So your beginning balance is 440. We don't know what the accrual is. The write-off is 290. We know that. And your ending balance is 580. Okay, so in the same vein, if we go A plus B plus C plus D, we know A plus B minus C, C equals D, right? And
Yeah.
same old thing. This time though, we're swapping B for D, so it's A, let's call it plus C minus D equals a minus B.
Wouldn't it be minus C minus D equals B?
Oh, because this is, I'm just doing this in, oh, we don't know B, so we're trying to figure out B.
Yeah, but C is negative already, so you can't change it.
Right.
It's on the same side of the account of the equation.
B equals D minus A plus C. No? If I keep B on this side and move everything over to the other side,
Oh, okay.
yeah,
I didn't say that.
that way we don't have a negative B. We
Yeah.
just know what B should be. So B
Mm,
equals D, which is already on the right side, minus A plus C.
yeah.
If we do that, then we should be able to do this. B equals, so D minus A plus B, 430. And we do that in the same thing that we did here, 430 through 90 equals. Just double check all this. But this one needs to be in minus. There we go.
Mm-hmm. Okay.
Okay. So this one was even tricky for me. Hey Todd, how's it going? The approach though is take the prior year balance, knowing the ending balance and the amount that they had in actual write-offs to figure out the bad debt expense,
Okay.
which effectively ends up being this amount. Because you're on this accrual is your same journal entry over here, right? Ends up being the same journal entry. Bad debt expense for 430 and your allowance is 430. It's a credit. It increases the value, right?
Mm-hmm.
That's why it shows up as at least a positive in this, because it increases the allowance balance.
Okay.
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 So exercise 7-7. Okay, did you have another one?
I do 17.
17.
Yeah.
There is no 17. There's only 13.
13. Sorry, then it's 12.
12.
It's 12. I had everything right. And on the general journal, I did notes receivable, debit, and then sales credit. And that's how I found it in the book, how it should be. But it tells me it's wrong. So I'm not sure why it's wrong or what other account I should put it there instead. I don't know.
Okay. Well, let's
The
look at
first part I had it right. Like I was able to figure out and I understand that part. But then the general journal,
the journal you didn't understand.
it, it just tells me that sales is wrong. So I put
Oh,
debit, not receivable for 28,000, which is my numbers here. And then sales, but then it says it's wrong.
okay. Well, let me do the whole problem and then I'll see if I can help figure that out.
Okay.
Complete a table to calculate the interest amounts due at December 31st and use the calculated value to prepare your journal entries. Use 360 days in a year. Okay. So we know our denominator. So if we take these, what does it, it gives you what? It gives you everything but the interest. Calculate, complete the table to calculate the interest amounts. Yeah, okay, so you're using this to figure out that. All right, so let's just do that in here then. And as I've mentioned before, my memory is so short term. Okay, I don't even remember what the answer was. Principal, rate, and time,
And then total interest at the.
and then total interest, right?
Yeah.
Just called interest. Okay, so through maturity, $14,000, 4% for 45 days divided by 365. Just got, this is for 45 days out of 360. Okay, and this one's $14,000, 4% for 18 days out of 360 years, 360 days. So you're first gonna figure out your principal times interest divided by 360 times the 45, right? And you got that probably. What I do wrong?
No, it is 45 over 360 times the whole thing.
Oh, I forgot,
So
divided by, I
so
put
it's
times.
15,000 times 4%, and then 45 over 360 divided times the whole thing.
Yeah, basically the same thing. So I'm just, so this part right here figures out a daily interest, and I'm just timesing it by the number of days
Yeah.
that they're doing. Okay.
Okay.
And then I just copied this over, and that should give me 28. And let's see if I get the same numbers. Oh my goodness. Yeah, 70 and 28. Okay, so then ask you what the journal entry is for the interest amount is my guess. So what ends up happening here then, your journal entries are going to be, let's just call this A, and this is B, they're going to be the same. So we got a reference, we got an account, we got a debit, we got a credit. Okay, so reference on A, we're going to have interest expense for 70. Credit's going to be for 70, and it's usually going to be an interest payable. Yeah, interest payable. And this is going to be the same thing for B, but for 28. Interest recognized December 31st. Maturity, only 18 days worth. So it should actually only be this one. This is the journal entry that they're looking for.
Okay.
Because this one is just the total amount, 45-day maturity of a 45 as a $14,000 note, and there's only 18 days that it was applicable to a particular period or for the year. So you're gonna journalize that one. That $28 should be interest expense at 28, interest payable at 28. That part right there. Oh, and they want you to do this component too. The actual principal side. So on the principal component, or you can see it there, but really you're just setting up the receivable. I won't come down here. So let's see, I'll just put it in here. Notes, receivable. And did they actually give you the name of the person?
Yes, on mine is M. Lee.
Oh, it's up here. Okay, I didn't read this. So on December 13th, $14,000 note. Got it. Okay. So then this would be not at 413. On 1213, you have the note receivable for M. Lee for 14,000, and it's going to be a cash on this side, right? Accepted a $14,000 45-day 4% note in granting Miranda Lee a time extension. Oh, that's not it. On her past due receivable. So accounts
I think
receivable.
sales, but I don't know.
Lee.
It's accounts receivable.
Yeah, it's accounts receivable because you're not getting any cash for it. You're just shifting your receivable from an accounts receivable, which is normally, within terms to a
okay.
note receivable. So that's all this is doing right here. You're not getting any cash. You're not
So it's,
giving
yeah,
them any cash. You're just shifting the account that it's in. And then you're recognizing the 1231 worth of interest. And you would have figured out that number of days. That's probably the trick here, how many days to put in there. So the 18, so this is beginning, ending. So this was beginning was 12/13, and this is 12/31. And most people just calculate the days by the net, if you just take that day minus that day, you'll get 18, not inclusive of the actual day that you issued it.
okay.
Okay. So that's how you come up with this, this other part,
So it
this
just
18.
changed, because in the book it says sales on the explanation to use sales with accounts receivable. So that's why I got confused. It just, so it's not at sale, it's just changing the how would you say that? So it changed the name
Or-
of the debt. Is that how?
Yeah, exactly. You change it from them owing you an account receivable, you sent them an invoice and they're
Mm-hmm.
not paying it. And you said, fine, we understand you're not going to pay the invoice, so we're going to convert it from an accounts receivable to a notes receivable. And that note, which is actually a negotiable interest instrument, is a $14,000 note for 45 days, right? And
Okay.
so arguably you could sell this to somebody and they can collect it instead of you. But the AR, you could actually uh, sell it to somebody and they can collect it too, but they just converted it to a note that they owed, that they owe, that they hold instead of an accounts receivable. So that's why you don't have the sales account here,
Mm-hmm.
because you're not generating any more revenue. You're just
Right.
shifting the account type. Yeah, that can
Okay.
be a little tricky.
And then you do have to register the interest that it's up to that date at the end of the period,
Yeah,
but you don't receive it yet, right?
that's correct. You don't receive it yet. So that's why it goes into an interest payable account.
Okay.
Actually, this is an interest receivable account. Sorry, I didn't even think about that. I was
And
thinking the other way around.
why is it interest expense? Because you're not paying it, like you don't owe it with
You
that.
are perfectly so. Thank you for reminding me of this. Okay, so this is the receivable because it's increasing, and you are going to interest income on this one.
Okay.
Great question. I was thinking one direction and it was actually the other. Nice
Right.
catch.
That means I'm understanding a little bit, I guess.
Yes, absolutely. You caught me in an error, and I didn't even pay attention to this. So yeah, so you do have the note and the receivable, and then the receivable and the revenue. I called it income. Usually this is below. It's not in the revenue section. It's down usually down below in the other income and expenses, and that's why I would call it interest income. But they have it as interest revenue.
Okay. So revenue meanings like a sale, right? Like, yeah, it's an income. I got
Yeah,
it.
yeah. Because
Okay.
usually interest isn't the sale. It's not really revenue. It's income.
Mm-hmm.
Um, it's down below the line instead of up in the revenue section.
Okay.
And I think that actually answered one other student's question. Perfect. Okay, so that was number 12.
Probably. Yeah.
Okay, I think one more was number 13. Looks like chapter 7, 13. So I'll do this one as well.
Okay. Yeah.
Okay.
I'm not there yet, but that's good.
Yes, you get a Benny for coming to the class exercise.
Yeah.
7, what is it, 722? It sure is. Okay,
7.
let's see if I can slow down on this one and get it right. The following information is from the financials. Okay, let's see. Whoops, I didn't want to do that. Well, I did want to do that because I want to copy it, but there we go. Copy over here. Now, okay. Compute its accounts receivable turnover for year 2 and 3. Oh, I hate these. These are so hard, but we will do it. Accounts receivable turnover. Year 2 and 3. Okay, so you have to convert your sales to days and figure out how many days there are in accounts receivable. That's the basic. I know that I know the formula is different than what I'm going to show you, but I'm going to show you how my mind logically works through this, because this is turnover, right? So how many days? I think that's what AR turnover. This is the way the AR days. That's the AR. Maybe I'm thinking of a different ratio.
Well, the accounts receivable turnover are just net sales divided by average accounts
Receivables, yeah.
receivable net. So
Right.
really it should be, in this case, 348,000 divided by 43,600.
Year 2 and year 3. So this is the average. Let's see, equals average. Average receivables. This right there. Oh yeah. So this is your turnover. AR turnover. Thanks, Todd. Let's see if I got it right. That would be this divided by that. Assuming this competitor has a turnover of 12.3, is Rahim performing better or worse at collecting receivables than its competitor?
Better.
Its turnover is better?
I thought better was a lower rate.
Turnover is how many times your AR is being turned over in a given period. So I would think that it's the higher the number, the better, because you're doing it.
Oh,
It's
you're
going
right.
It's churning more times than the other person, right? So I would. That's why I would say that's their worse. Would be my deal. Okay, so let's pull this up. Let's see if we got it right. So 7 times is year 2, 8.2 times. If we do this to the nearest 10th, 8.2 times, and we got that right, and we got that one right, and we got 279 and the 348 right. So thanks to Todd for giving me a little direction on that one. Remember, it's turnover, not the day sales one. I was starting to go down the day sales route, so forgive me on that one. That was number 1. And then number 2, it said better or worse, and the answer was worse. Okay, so that's number 13. Okay, any other questions? Todd, did you have any?
I have a question, but my question is from last week.
From last week, okay.
Because I think in the description you just gave, you may have answered why I got it wrong.
Oh, okay.
So last week, the week 10, the financial statement analyst, chapter 7, the very last section, there's three questions in a little quiz thing in there. And it's the first question, requirement number 2 is what I messed up on. And I'm trying to understand why I messed up on it. And I think it's because I didn't average out the accounts receivable. Yep, that's it.
This one right here. Compute Samsung's accounts
No,
receivable turnover.
that's question 3. We want to be on question 1.
Oh, question 1. Okay, sorry. What is the amount of Apple's accounts receivable? I feel like I've done this one before. I bet you there's a video out there on this one. I feel like maybe last semester. This is Apple. Yeah.
Yep. So
Okay.
the first requirement I got right. That was no problem. That was just dividing or looking at the spreadsheet and pulling what the 2019 accounts receivable net amount was. Okay. It's the second one that the second requirement is what I messed up on.
Oh, okay. Compute Apple's accounts receivable turnover as of September 2018. So theoretically, then if I use these same types of numbers, let me just copy
See,
this over.
that's exactly what I didn't do. I didn't average out between 17 and 18 what the accounts receivable net was.
Let's see, accounts receivable. Sorry, it's this one. 23186 and 17874. I gotta figure out their net sales. Consolidated operations net sales is 229234. And wrong one. I want to copy that one over. Wrong year. 265595. I think it's 129. I guess I gotta go to the next one. 129. There we go. Yep, that's probably what it was. Just averaging the receivables value.
So once you average, when you're dealing with multi-years for this particular thing, once you average the accounts receivable, your numerator then becomes the net sales for the given year, and then you divide it by the average.
Yep.
Okay. That's where I went wrong.
Yeah. Go ahead.
You do average just 2 years, right? Because I think I got one wrong. I don't remember where, because I averaged 3 years instead of 2. So you do just take
2.
2 years,
Just 2 years, yeah.
like
'Cause
12
you're-
rental years, and that's it.
Yep. Because the way to think about it is that this revenue happens over the span of a year, right?
Okay.
And these values that you have for accounts receivable are 2 points in time. The beginning part of the year and the end of the year. And so what you're really trying to do is figure out what your average receivable was for that whole year period of time.
Okay.
Yeah.
So you use the equation of average.
Mm-hmm.
Averaging would be the same as adding cells H4 and I4 to get a sum and then dividing it by 2.
Yes.
In that case, 2. In the other case, it would have been cells C4, D4, E4, sum divided by 3, because you're dealing with 3 years in that one.
Well, if you did a
in
3-year,
the 2-year column, you're dealing with an average between year 1 and 2. In the 3-year, you're dealing with an average between year 1, 2, and 3.
No, only these 2 right here. Because
okay.
If you look at the formula, I just copied it over, but it's just picking up these 2.
Okay.
It's not picking up 3. So you're only looking at 2 points in time. The beginning of the year and the end of the year, averaging those, and then dividing those into the net sales.
Okay. So again, this is where it pays attention to really pay attention to all the information that they're giving you, and don't jump the gun in the example that you did before, where you were looking at a 3-year. they gave you the information for 3 years, but they were only asking for an average of 2 years.
Yes, yeah, because the AR turnover is only 2-year
Okay.
number average.
Will it always be a 2-year turnover?
It'll always be a 2-year view. Yeah, because
Mm.
otherwise you'd have to, if it were a 3-year view, it would have to be the sales for these 2 years. Right, because I'm going from this AR value, which is which is the end of year 1, or effectively the beginning of year 2, and then you have these 3 points of time. You know, arguably you could say it's just the average of these 2 numbers, but you'd have to use these in order, and you'd have to have these 2 sales values to figure out what that is, but that really doesn't make sense either, so it all falls apart. So yeah, you just look at, you're looking at the AR turnover for year 3, you're only looking at these year 3 ending balance and year 2 ending balance, which is effectively year 3 beginning balance.
Okay.
Right, because these numbers, these just roll over from end of year to beginning of year, end of year to beginning of year, and then end of year. A little confusing. $41,400. That's 41,400. Sure. 38,100. Beginning, end. Same thing. Okie doke.
Cool.
All right. Any other questions I can help with?
I have one, but not from the homework. It's like a personal question.
Okay.
Yes.
All right. Well, I can wait. I can stop the recording if we're done with everything else. Hold on. And Todd, I think, are you done?
I am, and I have some feedback from you from the last exam we did.